This is CGTN, China Global Television Network.
Hello there, welcome to this edition of Global Business Africa. In the course of the hour, we'll run through the business news stories you need to know about from Africa and beyond. But first, a quick run through the markets for you. So the JSE's top 40 that started week 48. My word, the year really has gone by, hasn't it? Week 48, it did close over 1% higher. The JSE has not only clawed back most of the early losses we saw in the second quarter, but it's also gone up by about 3% so far this year. Until a rally that really gained steam properly in October, the JSE was the only large African bourse here, which we track, that had a positive position on a year-to-date basis. Nigeria's main index is 27% higher. Egypt's EGX30, that's down 22%. Kenya, which brings up the rear, that's with a year-to-date decline of 32.7%. Here's what's coming up tonight. Kenya turns to the IMF as debt levels soar. We'll have the latest data. A GDP contraction pushes Nigeria into an uncertain economic future. And we'll explore how the world's largest economies are going to deliver fair access to COVID-19 vaccines. Welcome to Global Business Africa. Let's start the hour with a view on the question of debt service and debt relief with perspectives from East Africa and West Africa. Our starting point of the hour is Kenya. Kenya is reportedly seeking a loan of as much as $2.3 billion from the International Monetary Fund under the Lenders Extended Fund facility. Now, talks on a possible 3.5-year program are expected to conclude sometime in early 2021, and Kenya is eyeing an initial disbursement of roughly $725 million in the fiscal year that runs through to the end of June next year. Now, according to the Treasury, the objectives of the loan include continued support of the government's COVID-19 response, as well as a reduction in debt vulnerabilities through a revenue-driven fiscal consolidation. The IMF back in May approved $739 million in lending for Kenya under the Rapid Credit Facility that was designed to help the country deal with the fallout from the COVID-19 pandemic. In the same month, Kenya got $1 billion from the World Bank, and that followed the lender's approval of a $750 million package for Kenya in 2019. Now, a story of this nature only makes sense when you put it into context. So let's try and do that with respect to Kenya. Among the countries eligible to take part in the G20's debt service relief program, Kenya stands out by its absence. You see, on the 20th of November, Kenya's finance minister said the country has yet to make a decision on whether or not to apply to take part in that debt suspension initiative, which initially was going to end in December, but has now been stretched out into June next year. As Okuritani put it, quote, "There has been no decision yet." And he added that the country has not applied for that G20 debt service suspension initiative. But that leads to another interesting question. Assuming Kenya had taken part in the initial phase from May, what exactly would it have gained? In October, the World Bank answered this very question. It pointed out that if Kenya had taken part in the debt deferral program, that could have freed up at least $800 million for the East African tea producer to spend on something else, like responding to the COVID-19 pandemic between May and December. And that was the second highest figure in their computations after Angola. Now, to be clear, this isn't saying that the amount of cash in question, $802.6 million, is written off. It just means that the country doesn't have to pay it when it's due, in this case between May and December 2020, but you will have to pay it later on. Now, $800 million, to be fair, sounds like a lot, but it's important, again, to put it into context. It'll barely get you about 0.2% of Tesla's outstanding shares, but let's put this in the context of Kenya's debt service obligations, because that's where the story really is. Between July and next June, Kenya will spend roughly $3 billion just servicing foreign debt, paying principal and interest. In the third quarter of this year, 42% of debt service costs went to commercial lenders, so that covers Eurobonds and syndicated lenders like Trade and Development Bank. Another 44.8% went to bilateral lenders. But the bilateral bit of it is a bit misleading, because 93% of interest payments and 79% of principal payments on bilateral debt went to just one country, China. So where exactly does this leave Kenya and this G20 debt service initiative? Let's explore that in a bit more detail with Churchill Ogutu. He's the head of research at Kenya's capital. He joins us now live from the Kenya capital, Nairobi. Churchill, good to see you on the program. So the success or the failure, really, of this idea of tapping into the G20 debt service suspension initiative, the success of it hinges on whether or not China takes part, doesn't it?
Yeah, thank you, Ramah, for having me on the show. Yes, it actually hinges on whether China comes in and takes up the initiative. Looking at the current financial year, we are seeing that out of the $3.3 billion that will be paid out as external debt service costs, Chinese payments is amounting to 28.4% of that total. And looking at the World Bank data statistics, we are seeing that for the remaining part of the fiscal year, that is between the months of December up until June next year, 70% of what is considered as official bilateral credit payments is due to China. So it's quite imminent, it's quite imperative that China should be part of the DSSI, as you correctly mentioned.
Indeed. So, but there are a few more interesting nuances to this story, because a lot of the debt that comes in, that's in question from China, is not explicitly defined as direct government-to-government lending, because it's mostly project finance issued on commercial terms. So, for example, the Exim Bank of China lending over money to the Transport Ministry in Kenya, that then lends that money on to Kenya Railways to build a standard gauge rail line. Does that legal ambiguity make these debts ineligible for the DSSI?
Yes, in a way, if you look at the scope of the countries who ideally should give Kenya the DSSI, are comprising of the official bilateral creditors, as known by the G20, the group of 20 countries, and also the Paris Club, who are also part of that initiative. China is not part of the Paris Club, and what we know from what has come out is that for Kenya to be able to get into the DSSI, at least it's able to send out a request to the Paris Club Secretariat, which will be able to disperse to the other 22 countries. And what we know with the Paris Club creditors, of course, they issue the concessional debt, as you correctly mentioned. Now, the issue that comes with China is that most of the loans that are issued are not government-to-government loans. They are issued by the Chinese state lenders, such as the China Development Bank and also the China Exim Bank. Of course, one of the things that you're seeing is that China Exim Bank is also considered as the only Chinese policy lender that is mandated to issue loans on concessional terms as foreign assistance. So that is quite clear. And what actually comes by concessional funding by a Chinese lender, in this case China Exim Bank, is that it has to be backstopped by the foreign aid, that's budget, and as opposed to the Chinese Ministry of Finance. So that's quite critical. For the Kenyan case, we really don't know which of these loans that we have received from China Exim Bank qualifies as concessional funding, which ideally should now be part and parcel of official creditor status as the Paris Club loans, and which part of that is now commercial loans. Of course, we don't know, we don't have an updated external debt public register, which is quite disturbing. People have been able now to nitpick that, okay, if there's any of the loans that have been issued on concessional terms, those could be part and parcel of what is considered official bilateral loans, which could be due for a debt relief.
Indeed, and just for the sake of our viewers, we're talking about $6.7 odd billion that has been borrowed by Kenya from China, from those two particular institutions that we're talking about here. Churchill, if Kenya doesn't take part in the DSSI, because realistically we only have another 6-7 months to jump into it, what are the other short-term alternatives that the country has to bring its cost of debt service down? And I ask this because if you look at the October tax data, roughly 50% of the tax revenue raised just went into debt service.
Yes, it's a pressure point on the budget, whereby we, for the financial year, we are looking at close to 55% of ordinary revenue going towards servicing the public debt. That's quite a concern. Looking at the current financial year, that said, we are seeing that $2.5 billion of that is going to project loans, ideally the ones that are given government to government, and that checks the box of concessional funding. So that's quite fair enough. And looking at also the other segments, at least in terms of external debt financing, we are seeing the program loans. That's where the IMF funding comes in. We have the World Bank, the third development policy operation to the tune of $1.5 billion. We have another funding by the Africa Development Bank, that's $500 million. So those are more or less considered loans that are issued on concessional financing. What the current National Treasury regime has come in, has stated explicitly that commercial loans are a no-no. And we saw even in the last financial year, there was no commercial loans that were issued. And even the current Treasury documents, you're saying that there's no commercial financing in the horizon. So that means that as we get the loans in concessional financing, that means that, of course, there's a grace period, and also the terms of the maturity of those loans are quite longer as compared to the commercial loans. So, of course, it could be argued that it's kicking the can down the road, because ultimately we'll have to pay back these loans. But compared to a commercial loan, which has an outsized bullet payment, with some of these multilateral loans, for example, they somehow stagger the payment throughout a period of, say, 30 years, which is quite manageable as opposed to a single bullet payment. So at least that is one way of containing the debt servicing costs that we're having in the country.
Indeed. One last question for you, Churchill. Despite everything we've discussed, I looked at yields on some of our Eurobonds, our 5 Eurobonds, and those have been falling fairly steadily since the second quarter. The 2024 10-year note, that was around 4.69% last week Thursday. The 7-year note due in 2027, 5.37%. What explains this level of comfort that foreign investors have with Kenyan sovereign debt, despite all the red flags that keep showing up in Kenya's public financial metrics?
One key factor that comes out is Kenya is also a beneficiary of even what's happening in the emerging market space and also the frontier market space. And the phrase that comes to mind is a rising tide lifts all boats, and that is actually what is playing out, and that's where Kenya is a beneficiary. If you look at the developed markets, whereby some of the rates, current policy rates, central bank policy rates are at ultra low levels. Some of them are even flirting with negative territory, and that also has manifested even in some of the yields in the developed markets. And now countries in the emerging market space, frontier market space, where Kenya is part and parcel of, are now beneficiaries. That's where now most of these crossover investors, who typically not only look at their countries of origin, they look at also other countries. They are looking at frontier markets as the next haven where they can be able to get real substantive yields. So that's where there's been a rush for investors to look at these markets such as Kenya. Of course, also the liquidity injection. When COVID hit, most of these developed markets had an influx of liquidity injections by their central banks, which now had an outlet and getting into some of these high-yielding asset class. Of course, finally, also, when the IMF came in and offered some backstop lending, that was between April, May, June period, that also gives some level of comfort to investors that, okay, here there's some IMF coming in to backstop these economies, which at some point, just when the peak of COVID, that was late March and early April, whereby now there was a sudden stop. Liquidity was not flowing to this side of the market. So most of that also impacted yields. We saw an uptick of close to 2% on average across the Kenyan Eurobond yields. But when the IMF facility came, that was around late May, we saw some steady, it gave some comfort to investors. So these myriad of factors have played out to see where we are seeing yields quite steady despite what's happening in the Kenyan sovereign.
Indeed. We'll leave it there for the time being. Churchill Luguzi from Genghis Capital, thank you very much. Now, from East Africa to West Africa. Let's head over to Ghana. The country's public debt as a percentage of GDP has gone well past 70%. The $46.9 billion in total debt that the country held by the end of September essentially is equivalent to about 71% of the country's total GDP. That's up from $35.8 billion just a year ago, by which time the debt-GDP ratio was just under 60% and still well within the sustainability threshold. Now, this sharp increase in public debt so far this year is primarily due to the cost of successfully navigating the COVID-19 pandemic. During that period of time, government revenues are constrained to the equivalent of just about 9.4% of GDP. Expenditures, however, shot up to about 18.4%. This came about due to the inevitable increases in health-related costs and social interventions in order to protect the population. Now, Ghana is not only Africa's second largest cocoa producer after Cote d'Ivoire, it's also another country whose debt metrics have investors concerned. Nabil Ahmed Rufai joins us from Ghana with more details on this story. So, Nabil, let's start with Ghana's foreign debt. Do we know if Ghana's Eurobonds or bilateral debt, particularly with China, do we know if those have any cross-default clauses embedded in them which would deem the country to be in default if it applied to take part in the G20 debt relief program?
Indeed, Ramah, Ghana has cross-default clauses in some of its Eurobonds and bilateral debts. And this could be the reason the country has been slow in really applying for the G20's debt service suspension initiative, DSSI. We know that should a country go ahead and apply and also obtain this debt service suspension program, it could risk triggering the cross-default clauses, which may not be too good for the country, because when it does that, it risks being downgraded in its credit ratings, and this could further make it difficult for the country to really access funds from the international capital market. So that explains the reason the country has yet to really apply for the DSSI and is trying to find other alternatives of trying to really deal with its debt, Ramah.
Just last month, the finance minister, Ken Ofori-Atta, he argued that there's a need for a much broader, a wide restructuring of the debt that has been issued by several developing economies like Ghana, like Kenya, Zambia and others as a result of the economic damage inflicted by the pandemic. But specifically in Ghana's case, what progress has been made in renegotiating the terms or restructuring the debt it has?
Well, for now, Ramah, not much has been put in the public domain as to how the government is faring in terms of renegotiating some of its debts with its lenders. But what we know is that, like many other African countries, Ghana has asked for extended debt standstill for about 2 years while it tries to bring its economy back on track. We are yet to hear if the lenders have agreed to this particular extended debt standstill. But aside that, we know that in the early part of this year, in March, when the coronavirus pandemic hit Ghana, just in April, the World Bank actually approved a debt standstill of estimated to be about almost $500 million in the short term, which went through deferment of interests and also principal payments, and that has been done. That was obtained in April this year. But in terms of the other negotiations, renegotiations with the lenders, the government is yet to come out whether it's been successful in getting some conditions or some terms agreed upon as of yet.
Okay, so the pandemic, as far as we can see from the data on tax collections, has blown a massive hole in Ghana's tax collections, $1.26 billion short of the tax target for the first half of the year. But beyond the tax incentives that were provided back in May, are there any other tax cuts or incentives that are planned for 2021 to try and revive growth and investment?
Well, Ramah, you know that Ghana heads to the polls on December 7, and we're not sure if the current government will be retained or a new government would come to hold the office of the president or so. But then what we know for now is that the finance minister has presented an expenditure for the first quarter of 2021, and within that expenditure, no mention was made in terms of any tax cuts or incentives for the year 2021. We know that this year, when the pandemic hit, the government, actually one of the key incentives that it did was to reduce electricity bills for lifeline consumers for up to 50% and also make water free for every citizen. And that is expected to continue to the end of the year, but the government has not stated if it will continue with this key incentive for the next year. And also one of the tax reliefs that we saw was in the service communication service tax, where it was reduced from 9% to somewhere around 6%. That one has also not been set if it will continue in the next coming year, which is the year 2021. So we wait to see how the elections would pan out, and when the government is retained or a new government comes, then we can find out if indeed there are going to be any further tax reliefs or incentives for citizens. Ramah.
Indeed. Nabil Ahmed Rufai there in Accra, Ghana. Thank you for your insights. Time now for a run through some company headlines. All right, then our company news wrap starts in the world of buybacks. NASPER's international investment vehicle Process has started the biggest share buyback in JSE history. Some $5.2 billion are going to be spent here. The group reported increased revenues for the 6 months ending in September. Process holds the group's international assets and it's listed in the Euronext Amsterdam exchange. It's a move that was made last September to reduce its weighting on the JSE and to open itself up to much larger pools of international capital. In East Africa, Kenyan banks cut digital lending to clients in the wake of a rise in non-payment following the 6-month freeze on listing defaulters with credit reference bureaus. KCB Group, Equity and NCBA all reported that they had slowed down the issuance of digital loans to avoid high defaults in the wake of a listing freeze that lasted between the 1st of April and the end of September. Still in Kenya, the national carrier Kenya Airways has launched direct cargo flights from its Johannesburg hub in South Africa to Maputo, Harare, Lilongwe, Lusaka and Dar es Salaam. Now with this new development, cargo from South Africa can now fly directly to these markets without having to go through Nairobi first. KQ projects a return to full operations in 2023. By the end of 2020, it's forecasting they will be operating at about 38% capacity, with expectations of operating at 60% capacity by 2022. And finally, some of the UK's biggest food firms have attacked a plan that could see all online junk food advertising banned as part of broader efforts to tackle childhood obesity. Firms including Britvic, Kellogg's and Mars say they support government efforts to tackle obesity, but they say that the plans were disproportionate and weren't, in their view, backed by evidence. The government has said, however, it's determined to help children and families make far healthier choices in what they eat. That's a run through your company headlines. You're watching Global Business Africa. Here's what's coming up next. As Nigeria falls into another recession in just 4 years, what lies ahead for it? And passenger car sales in Egypt went up by 24% in September despite the pandemic. We'll explore why when we return.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global Business, only on CGTN.
There's more to this place than just glorious landscapes. There's more to it than just, say, Table Mountain or glorious, endless salt flats. There's more to it than countries that are home to some of the deepest mines in the world. There is so much more to this place, even if it is home to some of the finest diamonds on the planet. It is the sheer diversity of the people who call Southern Africa home and the relentless drive to make it a better place that make it so special. And we know that because this too is home. No one knows Southern Africa like we do. CGTN, see the difference. Welcome back to the program. Let's head over to Africa's largest economy, Nigeria. It has slipped into yet another recession after its GDP contracted for the second consecutive quarter for the first time since 2016. Growth has been pretty fragile, and COVID-19 has hit Africa's largest economy pretty hard, and that's only compounded the problems already caused by low oil prices. The continent's top oil producer and exporter relies on the sales of crude oil and gas for 90% of foreign currency earnings. Now, Nigeria normally accounts for roughly 2 or so million barrels a day of output, but the effects of the pandemic and low oil prices have cut production to approximately 1.4 to 1.6 million barrels of crude a day. The recession 4 years ago was its first in about 25 years, and the country emerged from it the following year. All right, then, so let's dig into the numbers that came out of Nigeria with CGTN's Deji Badmus, who joins us now live from Lagos with more data on this story. So, Deji, the trade sector, let's start there. It continued its contraction in the second quarter, decline of about 12% or so in output. Can we attribute the bulk of that decline to the pandemic, or is it more to do with the fact that the country's borders have been closed to trade for the better part of a year now?
Well, Ramah, it's more to the pandemic, and the figures actually show that, and that's what the government too has been saying. Of course, you can also factor in the closure of the border, but it's more to the pandemic, especially when you consider the fact that you look at the decline itself, mainly driven by the oil sector now. Oil sector declining by 13.89%. That's about the highest contraction we saw now in the GDP figures. So, and if you consider the fact that the reason why we have this, apart from the OPEC cuts, we also know that prices in the global market now have significantly dropped, and you know, the global economy is yet to pick up, and so things are still things are still very, very dull in that market now, yet to pick up, and Nigeria is feeling the effect. So it's more to the pandemic, but no doubt at all, if you look at the fact that we also saw contraction in manufacturing and the industry sectors, you would also begin to understand. It gives you an idea now of how the closure of the border to is a factor, but not a major factor. I think the major factor from what we have seen, from the figures we have seen, is actually the pandemic, as of course the closure, the shutdown of the country, and of course most importantly, Ramah, for Nigeria, the collapse in oil price and that OPEC cut.
Right. So on the oil side of things, oil output did fall by about 370,000 barrels a day compared to third quarter of 2019. I believe the quarter-on-quarter decline was something around 140,000 barrels a day. But the crude demand, at least for the first half of 2021, is forecast to remain relatively flat, all things considered. So should we expect further declines in Nigeria's oil output, or is this it? This is the floor?
Well, you know, with the global oil market, you know, nothing is certain. It's very difficult to make a call at this moment. And of course, with the forecast that you have talked about, that is certainly not a good one for Nigeria, and certainly not a good one for other oil producers. The truth is that Nigeria would need prices to go up for it now to be able to make a full recovery. It is true that the contribution of the oil sector now to GDP in this country it's quite low, just in the region of 6 to 8%. But the fact is that the bulk of the country's revenue comes from oil, and it's this revenue that you actually need to drive the economy. So even when the non-oil sector is the major contributor to the GDP, the fact is that it doesn't generate enough cash, if you like, to drive the economy. So no doubt at all, if things remain flat, just as the forecast you have mentioned states now, then it means Nigeria would be in deeper troubles. Recovery would be probably very slow. The government has said it expects to recover, that this recession might probably not go beyond the first quarter, or at most, the fourth quarter now, or at most the first quarter of 2021. But of course, the government is basing its premise now on, the hope that that the global economy will pick up, especially with the announcements now around the COVID-19 vaccine. So if the global economy picks up, gathers steam, then there's no question at all that things may begin to look up. But honestly, Ramah, if oil prices continue to remain low, we might see this recession drag on for much longer than probably the first quarter of 2021.
And that sort of previews my next question, because the contraction this year was largely expected. It wasn't just Nigeria. Virtually most sub-Saharan economies all got hit in one way or another. But with respect to Nigeria, what are the growth trends that economists expect to see, not just in Q4, but also in the first half of 2021?
Well, some of the economists have spoken to say that they expect to see some kind of growth trend now, especially in trade, and that the hope, and everybody keeps pinning their hope now on these COVID vaccines that are coming up now, that the hope is that if these vaccines, if they're able to get, people are able to get vaccinated, and the world gets assurances now from the vaccine, and the global economy picks up, then there's likely to be that growth now in trade, because of course, as you mentioned, growth contracted significantly, and the border closure that you've talked about, the hope is that the borders will be reopened soon. The government says it plans to reopen the border. How soon that will be, we do not know, but also everyone expects that when the borders are opened, that would help to boost trade as well. Then in the non-oil sector, agriculture, the expectation is that we're going to continue to see some level of growth, even though the country is still battling insecurity, and that, of course, is affecting its performance now in terms of agriculture. We've also seen flooding now in some states, but the forecast is that we're going to see growth in the agriculture sector. But the most important thing that most of the economists have said is that, look, the government needs to create a better environment for investment. It needs to improve on its regulatory policies, create that enabling environment now for investors to actually come in and do business. Address the problem with the country's foreign exchange, that if all these are addressed, then maybe things would begin to look up, and then the recession would be probably shorter than everyone expects.
Indeed, second recession in 4 years. Let's see how this plays out into 2021. Deji Badmus, live in Lagos. Thank you. All right then, so let's move on to North Africa. Passenger car sales over in Egypt, they went up by 24% year-on-year in September. 17,051 vehicles flying off showroom floors across the country. Authorities over there attribute this recent rise in sales to purchases which had been postponed due to the outbreak of the COVID-19 pandemic. CGTN's Yasser Hakim has that story.
The COVID-19 induced lockdown and curfews pushed the Egyptian car market into a standstill from March to June. However, there's been a gradual sales growth since then, after buyers shrugged off the wait-and-see strategy adopted during the second quarter of the year. Omar Belba, a longtime car dealer in Cairo, says higher demand was expected from the month of September.
First of all, September, October and November, and generally the fourth quarter is usually the high season for sales, because that is when international car producers in Europe and Far East in particular release their new models every year, and clients wait for that period to buy the new model of the year. Let's say sales have also improved because cars have become a necessity product in Egypt and not just a luxury. People need cars because of the expansions in the cities, the new highways and roads, while the transportation system is still not fully developed to cover the growing population.
During periods of recession, prices of vehicles usually fall, but not this time. It has actually shot up recently despite the outbreak of the pandemic, as consumers adopt measures to coexist with the virus.
More than 50% of the vehicle plants worldwide have stopped production because of the pandemic. 50% of feeder industries and spare parts producers have stopped work as well. Therefore, production and supply have dropped by 50%, which has led to the acute price increase that we have seen.
Experts, however, have opposing views of how the market will react if the coronavirus pandemic continues for an extended period.
I am optimistic that people are learning to live with the pandemic and adapting to the coronavirus situation. I expect demand will continue to grow, but most clients will target cheaper cars than they had originally wanted.
As long as there is the coronavirus and there is no vaccine to kill it off completely, then all sectors of the economy, especially the car industry, will be negatively affected. It will suffer.
The conflicting views by experts is just a reflection of the uncertainty caused by the coronavirus in every aspect of people's lives. Yes, Hakim for CGTN, Cairo.
On to Zimbabwe now. A 40% pay hike for civil servants in Zimbabwe has been turned down by teachers who are holding out for a much higher offer, which matches the current poverty datum line, which is roughly $250 a month at the moment. Here's CGTN's Farai Mukhtar with the details from Harare.
The pay hike is meant to placate public servants, including school teachers, who constitute the bulk of government employees. Some of them have not been reporting for work since schools reopened in November. Unions representing them have rejected the offer.
That is not collectively bargained for, which means it was not a result of what workers had put down to say these are our minimum expectations. And secondly, it falls far too short of the current PDL, which as far as we are concerned is now well over 25,000.
After the adjustment, the lowest paid teacher will earn 18,000 Zimbabwe dollars, about $220 lower than the $520 they are demanding. Government has resisted the increments, arguing they would push up inflation and derail fiscal reforms. Its latest offer is seen having a negligible impact on inflation.
The major driver of inflation has never been cost-push inflation coming on the back of civil servant salaries. It has been exchange rate caused by excessive money supply. So because there's a cap on the money supply, there's a stabilization of the exchange rate because of the auction system. So the increase in inflation will be very marginal for November in particular. But on a year in inflation, I expect it to continue on its downward trend. I'm sure you're aware it's now 471%. So I believe in this November, it should be around below 400%.
Treasury has projected annual inflation would close the year at 330%. With more money in their pockets, civil servants will stimulate aggregate demand that has been subdued due to the economy and worsened by the COVID-19 pandemic. They'll also give a boost to local manufacturers at a time that the government is trying to domesticate production under its recently unveiled National Development Strategy. Government is expected to signal its commitment to the new blueprint in the national budget statement.
Our budget should not be focused on numbers because we don't have a lot of money to spend. It should be a reform-oriented budget. We expect the budget to then provide some tax incentives to support the value chains which were announced in the national development strategies.
The 2021 budget, which will focus on restoring macroeconomic stability, will be presented on Thursday. Farai Mukhtar, CGTN, Harare, Zimbabwe.
You're watching Global Business Africa. Time for a short break. Here's what's coming up. We'll explore how the world's 20 largest economies are working on giving fair access to COVID-19 vaccines. And Black Friday shopping sprees are starting early in 2020. We'll explore why when we come back.
Business in Africa is at a crossroads. We celebrate those who are adopting and thriving despite the challenges, from grassroots to big businesses. Global Business takes you along for the ride as we track the making of a giant.
Only on CGTN.
How will your world change today? What happens here? What happens there? what you make happen for yourself. If it matters to you, it matters to us too. Your stories are the stories that need to be told. Africa Live. Find your voice.
Welcome back to the program. These are some of the stories making your headlines at this hour. Starting in Ethiopia, the federal government there says its troops have started to encircle the Tigrayan regional capital of Mekele. That announcement comes a day after Prime Minister Abiy Ahmed issued a 72-hour ultimatum for the Tigray People's Liberation Front, or the TPLF as it's known, to surrender. The TPLF is the ruling party of that region. The military launched an offensive earlier this month after escalating tensions with it. Government spokesperson Redwan Hussein has termed the latest move as the beginning of the end of this operation. Across the border in Uganda, police have said that the death toll from last week's violent protests over the arrest of opposition presidential candidate Bobi Wine is now standing at 45. Police spokesperson Fred Enanga said that 17 people died over the weekend due to injuries sustained in the protests that took place on Wednesday and Thursday last week. Over in West Africa, vote counting is underway in Burkina Faso following Sunday's presidential and parliamentary elections. President Roch-Marc Kabore is battling 13 other candidates as he seeks a second term in office. Brutal attacks have forced more than 1 million civilians from their homes in the past 2 years alone. Election Commission Chief Newton Ahmed Barry told reporters that some polling stations in insecure eastern areas of the country had to close early on Sunday because people had been threatened by jihadists. And finally, the Electoral Commission in Liberia has confirmed that a referendum will take place next month. Voters will be deciding on a range of proposed changes to the country's constitution. That includes reducing the length of presidential terms and allowing for dual citizenship as well. The Commission said that procedural issues which risked derailing the exercise have now been resolved. Liberia's Supreme Court had previously threatened to cancel the referendum after discovering ballots that violated the law. That's a run through your headlines. Now, the G20 says it will strive for fair global access to COVID-19 vaccines. The leaders of the 20 largest economies in the world have held a two-day virtual meeting in a bid to better coordinate their global response to this pandemic. Hosted by Saudi Arabia, the group released its communique late on Sunday. CGTN's Jacob Greaves has been looking at the details.
The headline-grabbing pledge from this communique is a vow to spare no effort to supply COVID-19 tests, drugs and vaccines fairly and affordable to all people. However, the agreement stops short of mentioning how they would do this and, perhaps more importantly, how much will be spent. The EU had been pushing for $4.5 billion from the G20 to go towards COVID-19 related medical aid for poorer countries, but there's been no mention of that in the final communique. Another announcement from this G20 is the extension of a freeze on debt service payments for poorer countries until mid-2021. The G20 initiative has helped 46 countries defer $5.7 billion in debt payments, but that's short of the 73 countries that were eligible and promised savings of around $12 billion. The G20 has urged private creditors to take part in the initiative. The second day of the summit also saw a climate change discussion. Chinese President Xi Jinping called on the G20 to take a lead when it comes to tackling climate change.
First, we should strengthen our response to climate change. The G20 should continue to take the lead in tackling climate change. We need to follow the guidance of the United Nations Framework Convention on Climate Change and push for full and effective implementation of the Paris Agreement. Not long ago, I announced China's initiative to scale up its nationally determined contributions and strive to peak carbon dioxide emissions by 2030 and achieve carbon neutrality by 2060. China will honor its commitment and see the implementation through.
Whilst most leaders outlined efforts to reduce emissions or target carbon neutrality, current US President Donald Trump took aim at the Paris Climate Accord.
To protect American workers, I withdrew the United States from the unfair and one-sided Paris Climate Accord, a very unfair act for the United States. The Paris Accord was not designed to save the environment. It was designed to kill the American economy. I refuse to surrender millions of American jobs and send trillions of American dollars to the world's worst polluters and environmental offenders.
Trump's comments, however, come as the projected winner of this month's US presidential elections, Joe Biden, has pledged to rejoin the international accord. Jacob Greaves, CGTN, in Dubai.
Speaking of the United States, Americans are preparing to embrace this year's Black Friday shopping extravaganza on the 27th of November. But for some, the sales have already started because, as Mark New finds out, companies have really had to change their approach to e-commerce and Black Friday because of the pandemic.
This is Black Friday a year ago, and this is Black Friday today.
I don't have any thought of going to any store this year just due to COVID. It's just too much of a risk.
Black Friday started much earlier this year in large part because of Walmart's plan to keep people safe while also keeping them shopping. Instead of focusing on a single day, Walmart broke up the shopping holiday into 3 separate events, with the earliest beginning all the way on November 4th. Like many other brick-and-mortar operations, Walmart has combined Black Friday in-store specials with online promotions.
Identity crisis is the right word. If you are a retailer and you've spent your entire career learning how to drive doorbuster sales into physical retail stores, and this year you're not supposed to do that, what do, right? Black Friday is a super spreader event. The way they have responded to this is by really making sure that their online merchandising, their online inventory planning has been way better than the previous years, and trying to also make sure that they can do things like buy online, pick up in the store.
Kalyanam says e-commerce is making up only about 20% of early holiday sales, but it also depends on how one interprets the numbers.
How do consumers start their shopping journey? So if you go to a company like Google and ask them where are consumers starting their shopping journey, they'll tell you that it's not 50-50. It's a vast majority of consumers today, maybe as high as 90%, are starting every shopping journey online.
We thought that we would see more customers take advantage of these early sales, but from our initial numbers, we didn't see that case. And we're starting to notice more and more people are waiting for the last minute this year. It's sort of a slow grind upwards as we get closer and closer to Black Friday.
Fong heads Buy Via, a mobile app and website that searches for the best online deals. He says the pandemic has accelerated the shift from in-store to online shopping by at least 5 years. Fong also says this year's Black Friday is blurring the lines with the day traditionally set aside for online shopping, Cyber Monday.
With the pandemic and more people shopping online, you could say, what's the difference between Black Friday and Cyber Monday? Because Black Friday traditionally has been the day for retailers, physical retailers. Is it turning into the same thing as Cyber Monday? Yes.
Whatever was the playbook that we had for holiday shopping, this year with COVID, that playbook went out of the window.
Kalyanam says the anticipated outcome of the holiday shopping season is unclear, noting the gains of those eager to buy could also be canceled out by those who've recently lost jobs and are still waiting for stimulus checks to arrive. Mark New, CGTN, Mountain View, California.
Now, on the sidelines of this year's World Internet Conference is an expo dedicated to showcasing some of the latest items and solutions using bleeding-edge tech. CGTN's Yang Qingqi was exploring that exhibit for you.
This is the Light of Internet Expo in Wuzhen. A part of the World Internet Conference, companies showcase their latest high-tech products and solutions. People have been talking about smart cars for years, and while autonomous vehicles are still years away, assisted driving is now commercially available thanks to evolving sensor technologies.
We as a company bringing the autonomous driving assist systems that currently equipped in many vehicles. Currently it's level 2, and we also have another vehicle that system that is a level 4. I think L4 have certain commercial values, in more restrict low-speed applications. But most applications, I would say, in the next 10 years, will still remain in the we call ADAS, playing supporting roles. But even at the supporting roles, they are still can make driver safer and make the vehicle more easy to operate. We cooperate with almost every domestic Chinese OEMs, such as Geely, Chang'an, First Auto Works, and Chery. Currently, the installation rate is still very low, relatively around 10% of the vehicles, because these options are previously only available on luxurious vehicles. Now we're gladly to see that more and more installed on mainstream vehicles. Such vehicle behind me, it's only 100,000 RMB. So we expect more and more such systems to be installed in mainstream vehicles in the next 3 to 5 years.
Cybersecurity solutions are a highlight of this year's expo. While more consumer products go high-tech, more of China's infrastructure is getting connected to the internet.
If our electric plants, nuclear power plants, public transportation systems, or water supply systems get hacked, it would pose great risks to the country.
Qi Anxin is said to be a provider of cybersecurity services for the 2022 Olympic and Paralympic Winter Games.
Our cyber defense system is based on technologies such as big data. Today, we are able to pinpoint in real time which country the cyber attacks are from. Actually, we've been monitoring the cyber defense system of Wuzhen's critical systems as we speak.
Cybersecurity has consistently been a key topic at the World Internet Conference amid a growing global reliance on digital economy. Discussions this year will also center around the movement of data and information across borders, as well as digital governance. Yang Chengxi, CGTN, Wuzhen.
A quick run through commodity prices for you. Brent crude futures due in January up nearly 2% higher at 15.58 GMT, 45.77 a barrel at that point in time. The last time we were at those price levels, it was August. And the world seems slightly different and a bit more optimistic back then. Cocoa futures due next March. Those have popped a fair bit, up 1.44%, $2,751 a tonne. The bulk of these gains, though, have really come in November, with a near 22% rise since the month began. Here's what's coming up next. Farmers in Senegal are getting up for bumper groundnut sales as harvest season gets underway.
Africa is a continent of diversity, with varied climate and enchanting geography, and a people so distinct, but with a shared enduring spirit. We are at the heart of the continent to bring you the untold stories.
Let's have a look.
We celebrate Africa as it shapes its own destiny.
Aden, Tunis, Cairo,
Juba,
Johannesburg, Ethiopia,
Tanzania.
Africa Live. Find your voice.
Welcome back to the bulletin. So in Senegal, the groundnut selling season is set to start at the end of November. And right in the heart of the groundnut basin, farmers are already hard at work. They're awaiting the arrival of the first bulk buyers. Astatal has that story on Grassroots.
Taibanessen is about 240 kilometers south of Dakar. In this region, a local organization which brings together 2,000 farmers is processing groundnuts coming from the fields. On this site, there are 30 semi-industrial units operating at full capacity for the complete processing of the product.
I have grown 3 varieties of groundnuts this year on an area of 20 hectares. I had a good yield because I could harvest 180 tons of groundnuts. We are taking out the seeds step by step.
Before, all the work was done by hand. It was very hard for us. Now, with the help of machines, we do the shelling, sorting and bagging more efficiently. There are 40 people working in each unit. Every day they earn between 10 and 14 US dollars.
According to the Ministry of Agriculture, the harvest is abundant thanks to good rainfall and better preparation than in previous years. A record production of 1,800,000 tons of groundnuts is expected, compared with 1,400,000 tons last year. The government has also decided to set the minimum producer price at around $5 per kilo. Habib Cham is the president of the Groundnut Producers and Exporters Collective. In his opinion, it is important to help farmers to organize better.
We assist them. We provide them with good quality seeds and also good fertilizers. We also offer them differential price. They first only give us back what they have invested. For example, if we give around 10 US dollars per produce, they then will reimburse us without interest. It will encourage them to sell us part of their production. And we also organize them to keep a part of their seed to increase the cultivated areas year after year.
At the collection point, Habib Cham manages to gather around 600 tons of groundnuts each day. This allows him to have a considerable stock. Thanks to the signing of an agreement between China and Senegal, most of his groundnuts will be exported to the Chinese market.
We have the chance to access the Chinese market since 2014. I think the producers never had any problems since then, because the Chinese market offers us prices that are attractive compared to the local market.
According to Habib, this has allowed Senegalese producers to improve their standards of living. Astatal, CGTN.
A quick run through currencies for you. So we did discuss yield trends in the first part of the bulletin, but there's an interesting trend in some of the Eurobond yields and what that says about the issuers and how they're being perceived by the market. Kenya's 2027 note is mentioned, so yields on it spike all the way to 10.19% in March, but it's now shaved off nearly 500 basis points since then. It's gone as low as 5.144%. Ghana, which we spoke about earlier, similar spike on its 2027 note, up to 15%. Now it's down to just under 5.8%. Speaking of Ghana, the central bank did hold its policy rate at an 8-year low, 14.5%. It's kept it there for the fourth meeting in a row. And of course, for the crypto lovers among you, Bitcoin's dizzying rally to over $18,000 tapered off a little bit. Today, it was down nearly 1.3% at 1604 GMT, but that barely makes a dent in the 34% rise we've seen in Bitcoin so far in November. That's a run through your currencies, and that's it for this edition of Global Business Africa. We'd always like to hear your thoughts, your feedback. Bring all of it, mention it down in the comments below, and of course on all the contacts you're seeing on your screen right now. I'm Ramah Nyang in the Kenyan capital, Nairobi. Thank you for your company in the last hour. The World Today is up next from Washington, D.C.